Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for May 12th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We had our WASDE, USDA WASDE report out today. Sets the tone, I think, for the future of the marketing year now. Got, some things, I guess, out of the way, you could say, from the USDA. We had U.S. ending stocks come in a little bit higher than expected there for corn for the 23-24 season at 2.222 billion bushels. Soybeans came in higher than expectations there at 335 million bushels. The wheat, though, coming in well below expectations, the tightest carryout we've seen in a long time, 556 million bushels there, and really on the back of just a abysmal production number. And when you really take a dive into that wheat contract, let's start there. Let's look at the daily chart of that KC hard red winter wheat, because this is where the story is finally being told by the USDA. But I still am like almost flabbergasted that the KC wheat market needed the USDA to somehow confirm that that the winter wheat acres are a struggle here, right? And that there isn't, major droughts and there isn't a crop that, there's a reason we settled the day. Oh, geez, what was the KC Chicago spread? 243 and a quarter into the end of the day there in this KC Chicago spread. I mean, there's a narrative here in the wheat market that the spreads are like screaming, right? I do think this spread has gone, absolutely out of control. There's a reason we call these widowmakers, and this is the type of year. Back when we were crossing $1 over, I would be the first one to say getting to $2 over was going to be a struggle, or you needed to see an extreme narrative, come, to drive that. Well, okay, we're seeing it right now. This incredibly tight carryout. The discount, our price of wheat has hit on the global market, a falling dollar, coupled with then the USDA confirming, the production numbers we all feel seeing and weren't expecting to see, right, by the trade's anticipation. Boom. In just a few days' time, actually 6 or 7 trading days, we trade from $1.40 over to $2.40 over in that July KC Chicago spread. And it's not just the KC Chicago spread either, right? It was that corn to wheat spread too has been a big mover. Maybe putting in a little bit of a reversal here, where wheat is finally, fighting to come off of its lows, and if KC is going to lead the way, we would expect to see this, corn wheat spread widen out too. But Chicago wheat trading 635 even, up 7 3/4 cents on the day. Little lackluster. We struggled to rally and break above the 18-day moving average, but we cleared the book, so to speak, right? There really isn't much resistance, this market told us, until we get back to 660, get back above that 18-day moving average, and that's in the near term what you're going to look for the bulls to kind of take out. We're going to try to hold the multi-day low at 630, and they want to then start taking out the highs. Then you're talking this 55-day moving average at 683 is your next resistance. 721 is your 100-day, but that 200-day moving average up around 780, it just should be one of those levels of mean reversion to consider on the way back up. Downward sloping trend lines against the highs in the Chicago wheat come in right around the 680, around that 55-day moving average. So I really do think that'll be the next, a break above today's highs would kind of confirm, in my opinion, the move towards that area. And that's, got a solid 30-cent, room of upside to there. So we'll see what happens there in the Chicago wheat. The KC wheat has obviously proven itself today. We ran above the 200-day moving average, closed and settled above there. It's 877. Would have been a lot more bullish if we could have closed above that 886 prior high here. But really, I mean, right back to the high end of the range, this $8.80 to $9 area. Definitely want to see wheat, push above there. But closing up here into the end of the week, this is about as good of a close of the week as you could have gotten. I hate that, it's 23 cents off the highs. I'm really rooting for KC wheat. I have been, for the last year if you've been working with us. But today we also saw something else interesting happen, which was the confirmation of the 10-day moving average moving above the 18-day moving average. This crossover is usually good for some kind of trend move in wheat. And in fact, if you look back through January this year, absolutely every single time this is that gray and red line crossover in the wheat, in KC wheat, there's an extended period of a trend. Well, that's the trend reversal. We're above every moving average we track here now for KC wheat. So ignoring this and not saying that we aren't in some capacity staging a reversal on this chart is just ignoring the technicals at hand. Now, this could be a short covering rally that we find our way into some other resistance, maybe $10. I think we're going to find struggle to get back above there, but there's plenty of room on this chart higher if it wants to go there. The fundamentals back it, and the short-term technicals do as well. But we have progressed very far, very fast. Some of the other markets haven't followed suit, so this could still pull back, right? And while we're above $8, while we're above that 18-day moving average at this time, that's about as much as you can give it. I don't want, and you wouldn't expect to see us back below 840, but nevertheless, retesting that area as support isn't out of the question just yet, right? So, all right, so that's the wheat market in the near term. Really only have major comments about the KC because we got to get through beans and corn here shortly. But 50% retracements off the highs here, this 870 to 888 area, that is certainly the resistance I think we're running into. But pushing above there, right, $9 to $9.20, that's where the shorts start to really puke or we start to do more damage to the downtrend, right, than the uptrend had. Short term for Chicago wheat, this low here around 630 is very important, I think, to continue to hold. 620, it's kind of the supportive area, right? But this 660 to 680 area is going to be resistance that we'll have to chew through. The 50% swing from 735 highs to lows here is still intact. Certainly have to at least consider, did the market rally up into 50% shorts from highs to lows here? Well, it did tag 618 line. So 618 line hit. Probably, at the very least, you should be considering some sideways price action in the near term for Chicago wheat. But if it moves, it's going to continue to move anything like the KC contract or follow suit there. Awesome. One problem, though, I have here, and we'll talk corn now with that bigger carryout, because I think that the soybean market, I'll mention, get a little more in detail on what we saw on the ending stocks there, but there isn't as much of a conversation there of what we saw on the report. Generally speaking, it was, 40 million bushels off from our expectations and such. That's not great for soybeans and that ending stock number, but it justifiably so. It's within margins of error on some of the numbers there, right? Corn, we'll talk about where some of that extra some of those extra bushels came from and where the USDA put them, how they found those on the chart, and it was a little surprising. And I think the unfortunately for corn here, the devil is in the details for corn right now, and let's get into it now. So 2.222 billion bushel carryout for corn on the bearish side of expectations for the trade. Actually, it was more bearish than almost everybody. Anyway, we're having a hard time, justifying that number, right? When we know that the USDA had to use the 181 yield number from the USDA forum, and they had to use the 92 million acres from the intended planting number in this report. That means that their supply side is pretty much set in stone. They're not changing that. And anyone who is speculating on what they might do with yields or acreage into this May WASDE, I hate to say it, but you didn't know what you're talking about, because the USDA can't change those numbers. They have rules to follow, and one of those rules is they cannot change those unless the April plant, or unless we had a delayed plant through the end of April, which we did not. So knowing what the acreage number is going to be, knowing what the yield number is going to be, knowing that they're very high, right, in terms of a supply, the USDA had to find effectively added in 700 million bushels of aggregate demand from 350 more residual and feed usage and 350 more export usage. So they're building in the case that for the rest of the year, they can walk back on acreage and yield, but the ending stocks number isn't going to change because they can also remove some exports, remove some domestic, usage and feed, because year over year, adding 350 million more of each, that's 700 million bushels, right? That is not a 40 million bushel difference, of discrepancy that we see in soybeans on the demand on the sheet. This is 700 million bushels of built-in excess demand that might be there to absorb in the event the USDA has to knock down production and supply. So, you consider that, and is any of this, can you discount, right, what the USDA put out here in terms of what we've been saying is the biggest and should be the biggest production number, the biggest yield and the biggest acreage for this year for corn? That we don't deny, but there's a reason we were down 5 cents in December corn and up 4 in July. They're bear spreading on the back of, I think, that notion. Anyway, how much further down can December corn go here? We've definitely broke below that 540 area, which was our kind of line in the that old range. I definitely think we could see a rally back up to 550 to 570 to test that broken support now as resistance, downward sloping trend lines, 55-day moving average at 555, 100-day at 572, 200-day at 591. Plenty of room of upside for corn if it wants to go there. Testing the $5 figure was basically testing a 50 to 61.8 line area from our last swing for corn from the May 2020 lows to the highs after. So it's 2 major steps forward, 1 big step back, and 3 waves for corn into $5. I think this is capitulation for December corn into the $5 figure. Do we see it go below? I don't know. I would love to see us start getting some short covering, because now that we have those big production numbers out of the way, we know that, right, all we can argue about is demand and weather markets, right? And, justifiably, I think we have some room to build some more weather premium back in. But how high will that rally go? Will it be a bear market rally? Get some sales done on a move back to 550 to 560 if it happens, right? That's the common sense thing here on the technical chart to do. In the short term, July corn here, not as bearish, actually kind of an outside day with a green close. Again, I think a move back above $5.95 to $6 on this chart. The recent highs, everything screams of a short covering, and I think would be a leading the way for July corn. That would be back above the 18-day moving average. That would get us back up into the range that we are in. 55-day moving average at 614, 635 100-day, and that 200-day at 649. Not as much to talk about on the charts here as there was, I think, to just discuss with everyone. That there were some devil in the details, as I said before, in that corn number, which we've discussed, we've talked about. Great. And we do wonder, right? No, never mind. I know what I was going to say. So still kind of sideways in a range here at lows. We didn't get much out of today's price action for corn, and everything I talked about yesterday is still intact. We're right in the middle of the range for the month. I still think we need to test 610 to 620. Some levels that the shorts would probably sink their teeth into, or sellers want to be into anyway. So let's see if that happens. July beans trading down 15.5 cents in the day. A terrible close for beans, which beans are the, where I think there's the most potential for upside on the chart now. Carry out still tight. 335 million bushels can quickly become 180 million bushels, as my colleague Ted pointed out with some quick math of just shaving 2 bushels an acre off of the yield we saw today. So the devil baked into the corn details of excess supply is not, or demand is not there for soybeans. So I think the lower we go on the soybean chart, there's more and more opportunity. Question is, are we trading down in a technical range? We have room on the July beans in this large range we've been in, down to $13. We can close this open gap at $13.54. Now that we're below this upward sloping trend line, we're, the trend line from March lows through lows, we're below it. We came back up, we tested as resistance. We failed at the 10-day. The 18-day has been resistance. Unfortunately, I think we're probably going to flush out for a move down to $13.50 to $13 on the Novi beans. I hope I'm dead wrong, and next week we come in and we're back above $14.15, but we got to get back above highs of today for me to be a buyer in the beans at this point, and Novi beans or July beans at this point. Novi beans, yeah, you know, hard not to say kind of the same thing here, breaking below this trend line now. I mean, it's just a downtrend until it's not. I think now we're coming down to test this, 12, 15 low here from summer months. So that would complete a big 3 waves lower. If we get below that level and into $12, it just kind of looks like what's happening needs to happen on this chart. And we'll continue to watch that. But I think there's a lot of opportunity for short covering in the soybeans and for building in some weather premium in particular, now that we're really, really washing it out of the chart. In the near term, it's hard here, the 4-hour chart, 1446, highs to lows, 1416. That was the 50% area, 2 steps down, 1 step up. 2 steps down would take us down to 1370, and I'm fearful, right, that would start to slide down towards 1351 open gap below those trend lines. Fortunately, it just looks like a market that's about to flush out to the downside, and that's where I got to leave us for this weekend. Not the best news for soybeans on the chart. Better news on what the USDA told us. Corn looks better on the chart, but was maybe hiding some details there that aren't that great for the demand side. But I think at the end of the day, KC wheat is where